How does a 9-digit office sale impact San Francisco's commercial real estate landscape? Welcome to the Commercial Real Estate Insights podcast. I'm your host, Steve Hamoen. Let's get right to it. In a significant development for San Francisco's commercial real estate sector, Blackstone and Divco West have closed the city's largest post-pandemic office transaction. The joint venture acquired 199 Fremont Street for $111.34 million, making it the first office investment sale over $100 million in the city since the pandemic. This transaction values the 420,000 square foot building at approximately $265 per square foot, marking a notable milestone in the recovery of the office market in San Francisco. The acquisition of 199 Fremont is not just about the numbers. Blackstone and Divco West plan to rebrand the building as 300 Howard Street, transforming it into a high-performance hub for today's ambitious teams. Planned improvements include a new amenities floor with a conference center and fitness and wellness facilities, aiming to attract tenants to the currently vacant building. This aligns with a broader trend where investors acquiring office buildings at discounts from pre-pandemic pricing reinvest savings into upgrading the properties. This major deal comes at a time when institutional investment in San Francisco's office market is starting to pick up again after having largely stalled in the years following the pandemic. While challenges remain, such as high vacancy rates and less established pricing, the situation is gradually improving, with leasing activity showing signs of recovery. Blackstone, for instance, has seen meaningful improvements in leasing activity in the city, suggesting a hopeful outlook for the market. For a Canadian perspective, particularly in regions like Kitchener-Waterloo, London, and Cambridge, Ontario, the commercial real estate market is also experiencing shifts. Office and industrial spaces continue to be in demand, with investors looking for stable returns amid global economic uncertainties. While the scale may be different, the underlying dynamics of market recovery and adaptation to new tenant needs resonate across borders, showcasing the interconnected nature of commercial real estate markets globally. Catherine Nikis-Boulos from Elite Agent highlights why commercial property continues to be a safe haven for investors, especially during times of market volatility. As global trade tensions and tariff speculations have impacted equity markets, commercial real estate's stability and income potential are attracting more interest. Yash Mendis, a national partner and head of agency at Burgess Rawson in New South Wales, notes that while Australia's S&P/ASX 200 index experienced some fluctuations, commercial property stocks have outperformed, showing a gain of 1.8% compared to the broader market's 0.2% rise. Mendis points out that this outperformance underscores the confidence institutional investors have in commercial property, especially given its resilience amid global economic uncertainties. Key players in the sector like Goodman Group, Stockland, and Charter Hall have seen significant gains, reflecting this investor confidence. With the Reserve Bank of Australia keeping the cash rate steady and potential interest rate cuts on the horizon, the appeal of commercial real estate is likely to grow, as lower borrowing costs can enhance yields and investment viability. Interestingly, policy certainty is becoming a significant factor driving investment towards specific asset classes. For instance, in the early childhood sector, both major political parties in Australia have committed to reforms that include substantial wage subsidies and expansion programs. Such initiatives are drawing investor attention to childcare facilities, particularly in areas with strong demographic growth and government backing. This focus on long-term income-producing assets is not just an Australian phenomenon. In Canada, particularly in the regions of Kitchener-Waterloo, London, and Cambridge, Ontario, investors are similarly drawn to commercial properties for their stability and growth potential. The demand for multifamily, tenant leasing, and industrial spaces remains strong, mirroring the trends seen in Australia. In the United States, the commercial real estate market is also witnessing a renewed interest in stable asset classes. Investors are focusing on properties that promise steady returns and are less susceptible to market swings, which aligns with the global narrative of commercial real estate as a reliable investment choice amidst economic uncertainties. The Commons at Willowbrook, a sprawling 441,000 square foot regional power center in Northwest Houston, is undergoing a significant renovation. This ambitious capital improvement project, led by Willowbrook LLC, aims to revitalize the center's appeal and functionality. Key upgrades include the installation of new monument signage and pylons, enhancements to the landscape design, and the widening of the main access point to improve traffic flow and accessibility. Currently, the center is 85% leased, hosting a variety of well-known tenants such as Marshalls, Home Goods, Ross Dress for Less, Michaels, Total Wine and More, Ulta Beauty, DSW, and Daiso. These renovations are expected to bolster the center's attractiveness to both consumers and potential new tenants, fostering a more vibrant retail environment. Vincent O'Toole from Avison Young is spearheading the leasing efforts for the property, ensuring a strategic approach to tenant acquisition. This development reflects a broader trend in the commercial real estate sector, where retail centers are being reimagined to enhance consumer experience and tenant satisfaction. In Canada, particularly in regions like Kitchener-Waterloo, London, and Cambridge, Ontario, similar initiatives are underway to rejuvenate retail spaces and adapt to evolving market demands. These efforts underscore the importance of strategic investments in infrastructure to maintain competitiveness and relevance in the market. Across the border in the United States, retail centers like the Commons at Willowbrook serve as examples of how strategic renovations can drive leasing activity and tenant retention. As these centers are upgraded to meet contemporary consumer expectations, they become more appealing to investors seeking stable returns in the retail sector. This cross-border relevance highlights the interconnectedness of commercial real estate strategies and the shared challenges and opportunities faced by markets in both Canada and the United States. In a move that is set to reshape the River North neighborhood, Zev Salomon has announced plans for a new residential development. The proposal includes a 149-unit apartment building slated for a surface parking lot at 320 West Huron Street. This location, which has been considered by other developers over the past decade, will now be transformed into a significant residential project. The planned $50 million development is anticipated to bring new life to this part of Chicago, offering modern living spaces in a prime location. River North is known for its vibrant cultural scene and proximity to downtown, making it an attractive area for residents seeking both convenience and luxury. This development aligns with broader trends in urban living, where there is a growing demand for multifamily housing in city centers. As urban populations continue to rise, developers are increasingly focusing on creating residential spaces that cater to the needs of modern urban dwellers. In Kitchener-Waterloo, London, and Cambridge, Ontario, similar demands for multifamily housing are evident. The regions are experiencing significant population growth, leading to an increased need for housing solutions that accommodate this expansion. Developers in these areas are also looking to leverage prime locations and offer amenities that appeal to urban residents, much like the River North project. Comparatively, in the United States, the focus on developing multifamily units in urban areas like Chicago reflects a cross-border trend that emphasizes the importance of strategic urban planning and investment in residential real estate. As cities on both sides of the border continue to evolve, the demand for well-located, high-quality housing remains a top priority for developers and investors alike. In Southfield, a significant mixed-use development project has secured a substantial public funding boost. The project, led by Middle Point Investment Group, has received approval for a $131.8 million transformational brownfield program incentive package. This funding is a part of a larger $209.5 million development proposal that includes the construction of 5 new buildings. The ambitious project will feature 577 apartments and 42,700 square feet of retail and commercial space. This development aims to revitalize the area by providing modern living spaces and enhancing commercial activity, contributing to the economic growth of Southfield. The approval of this funding package highlights the importance of strategic investment in urban development and the role of public-private partnerships in driving transformational projects. By leveraging public funds, developers can undertake large-scale initiatives that might otherwise be financially unfeasible, ultimately benefiting the broader community. In Canada, particularly in regions like Kitchener-Waterloo, London, and Cambridge, Ontario, similar initiatives are being undertaken to revitalize urban areas and meet the growing demand for multifamily housing and commercial spaces. These regions are experiencing significant population growth, necessitating the development of new residential and commercial properties to accommodate this expansion. Comparatively, the focus on mixed-use developments in urban areas like Southfield reflects a cross-border trend that emphasizes the importance of strategic urban planning and investment in residential real estate. As cities on both sides of the border continue to evolve, the demand for well-located, high-quality housing and commercial spaces remains a top priority for developers and investors alike. Thank you for listening to the Commercial Real Estate Insights podcast. I'm your host, Steve Hamoen. See you on the next one.